Hello, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is our good friend Mike McGlone, senior commodity strategist at Bloomberg Intelligence. Welcome back, Mike.
Hello, Ivan. Thanks for having me back.
Yeah, it's a huge pleasure always having you on and talking about the markets and what's developing. We'll see what Powell's about to do. Mike, the delinquencies by type of debt is starting to rise at an alarming rate. More Americans are falling behind on their car loan and credit card payments than at any time in more than a decade. How alarming is that? What is your outlook?
Ivan, it's very alarming. And let's just look at it from a factual standpoint. The fact that the Federal Reserve is still hiking rates and still expected to hike rates at the next few meetings, September and November,
Hmm.
despite things like that, is part of what I view as part of this great economic reset just getting started. Now, I've been early. I've been wrong on that call, but sometimes it's persistence that matters, and everything like that you mentioned are just those little things
Right.
that I think are all tilting that way towards we should expect a reciprocal economic response in terms of what happened with the biggest pump in liquidity that's
Yeah.
still dumping, and what you're showing there is liquidity dumping.
Yeah, absolutely. And you see there's $33 trillion in government debt now, 2 trillion annual deficits projected for the next 10 years. It'll take us to about 53 trillion in debt with that projection. If we have a recession, where does where like you see tax declines, Mike, and you see spending increases for bailouts, you see more stimulus checks going out in the next 5, 10 years. What happens to the debt bubble at that point?
So that's a problem with the trajectory is we're getting this spike in debt
Right.
despite this pretty significant economic expansion. And a lot of that is because of the programs of Biden economics, the war, supporting the war in and helping the Ukrainians and people in Ukraine. Um, and what you point out is a body in motion I'm very concerned about. Now, because of those notable mentions, we've spiked up in interest rates lately. We've kept the Fed, and because of this massive fiscal stimulus, which is increasing the debt, it's kept the Fed hiking rates and vigilant against inflation. It's kept inflation strong. You see the lose-lose there? And
Yeah.
that to me is part of, it still fits into my great economic contraction reset is what I think will happen. My base case is we will get this normal trajectory where the economy contracts, we get a recession. Um, but what's happened is the Fed will not be able to ease with the ease they ever have in the past when stock market starts going down because
Right.
of the lessons of it'll resonate back to the Weimar Republic in Germany, where the Germans were so hesitant to pump liquidity in the system because of all that inflation. But we have that now, and it just hasn't been tested yet. So I fully expect treasuries and bond yields will drop a lot. A
Hmm.
good example of that is Japan. We're all becoming Japanification. Um, but yeah, those are trajectories. The key thing that I think I need to point out about what you pointed out there is, yes, those are a problem. But what
Right.
just happened recently with Fitch downgrading U.S. jet debt is a tilt in the wrong way, but it also shows the strength of our system.
Right.
And that is, Fitch is a U.S. company. And Fitch is pointing out things that we need to know. We do not have people like me or entities like that in China or Russia to tell the leaders what's going wrong and what they should do about it.
Mm.
So that's one key thing to remember about it. But the trajectory that you pointed out is quite negative. And it's what unique thing about it is a lot of that's because all that fiscal spending is keeping the Fed to tighten more, which is part of the train wreck or lose lose I keep think it's coming for risk assets. And the number one thing that's holding us up still is the U.S. stock market remaining resilient.
Yeah.
And I think at some point that's going to roll over and then everything falls. And so we can move on from that one, I guess.
Yeah, yeah, no, that's you make a great point because once everything boils over and let's say the stock market stops holding up and then you see treasuries start to drop at an alarming rate, would that what would that affect, Mike? Would that sort of affect housing markets? Would that affect the commercial real estate industry?
Everything.
Like, yeah, everything. That's crazy.
So it's already
Wow.
happening. So I'm glad you mentioned housing. Existing homes for sales collapsing. It's near the lows that we've had in the last 20 years. We also have happened with mortgage rates are just absolutely parabolic, and the
Yeah.
spread versus U.S. Treasuries is quite wide, showing that wide spread. And so the housing market's locked up. Yet new homes under construction are near the highest ever. That is a train wreck, another one waiting to happen, because that means that supply is coming on from builders who are going to overbuild and already are overbuilding. They're providing some incentive to their clients with lower rates, but your average person can't afford to buy a house, and your average person who owns a house doesn't want to sell because the
Right.
rates are so high. That's just a lose-lose for the housing market. But it's classic cyclical, reciprocal action. The key thing I need to point out to all strategists, is all our listeners and all investors, is never forget from where you're from and how you got there. The
Hmm.
pump we saw in the housing market over year was up about 20%. That's never happened. FHFA data, we think we go back to 72 on that.
Yeah.
And that's similar to what happened to that spike into the peak in 2006. We just went up too far. And right now we're in the process of going down. The question I need to ask myself and markets is, what stops this revision trajectory?
Hmm.
And typically it takes some form of long lag to Federal Reserve easing. The bottom line for everything now is you're seeing all those tilt towards bad things in recession. We had personal consumption expenditures coming out today. We're Thursday,
Hmm.
the last day of August. Yet the Federal Reserve is still tight and still expected to tighten. I piked WIRP function on the terminal, and I see that they're up, what, 10% for the next meeting, 15 or 30% in November. I just got to
Right.
come up, so I was typing it wrong. Yeah, so I have 10%. So that's the point. We're still priced for that tightening. So that's why I think we're at the lose-lose. All that data you pointed out, everything is starting, most big things, except here's one key lagging
Hmm.
thing. Unemployment expected around 3.5%. That's
Right.
the lowest since, is it 69? And there's 100% correlation with unemployment rising from levels like this. It's only happened twice in history because it's so low,
Hmm.
and a severe recession. So to me, that's where we're going.
That's super interesting how you put that, Mike. And what do you think? How would it affect gold and silver? We're Wall Street Silver, so obviously we love the precious metals.
Yeah.
With all this chaos in the markets that's coming up soon, and what we're going to be seeing with treasuries and bonds, what do you think happens to gold and silver and precious metals?
So I'll stick with gold and
Yeah,
precious metals, and I don't bucket silver as much in precious metals anymore. It's almost 55% industrial, and every day that goes by is more industrial. Central banks are not buying silver, they're buying gold. And I fully expect gold to remain one of the best performing assets. So far this year, it's been beating almost all commodities.
of
It's up
course.
10% on a 1 year basis. Commodities are down 13% or 14% on a 1 year basis. So my base case is gold is going to be still remain one of the best performing assets in the next 12 months, who knows, number of years.
Hmm.
The problem I have with silver is it's much more like copper. It's tilting more like copper, an industrial metal. And if we get this tilt towards global economic contraction, which it's happening in China, it's happening in Europe, it's happening in the US, just about time, that copper almost always suffers. And I think silver is going to be at risk of following copper lower and less inclined to go upwards with gold. What typically will take for silver to break out higher is expanding economic growth, which is not happening. It's going the other way, and Federal Reserve easing. So concerned about silver. My bias still is my base case remains for gold to continue to outperform copper. It's been doing that for many years, and it looks like it's ready to break out. For gold to continue outperforming most broad commodities, I'll be publishing, by the time we hit the tape on this, I'll have published my outlook, and that's kind of my title. It's been my theme for this whole month.
Hmm.
And then that's the problem with silver. Silver around $24 an ounce has been stuck there for a while. And here's the bottom line with gold. The average price for gold this year is $1,933. That
Hmm.
year, 1933, harkens back to when I love using this analogy. It's the average price here harkens back to when President Franklin Roosevelt, took U.S. off the gold. We basically debased the dollar versus gold. That ended deflation. That bottomed the stock market in dollar terms. So I'm quite bullish gold, and I'm indifferent. I'm actually very concerned about silver falling, risk assets like copper in the stock market lower, which is typical in a global economic contraction.
Until you think the Fed eases, and then you think the silver would go great. Because what we're
I
following is we're waiting for the Fed to ease, and we truly believe that silver will go higher once the Fed eases, of course.
don't really know for sure. That's the problem I have. It's stuck in the middle. We'll have to see. Like I said, I think gold has a higher probability of rallying. In my
Yeah,
base
yeah,
case was severe economic recession. But the key thing about the Fed to ease is the last two bottoms in the stock market, of which copper is very highly correlated. If you look at copper, overlay it with the S&P 500 and divide by 1,000, it's like the same price since 2015. The last two bottoms in the stock market came almost 2 years after the first Federal Reserve ease. So let's put
mm,
copper in that bucket with the stock market
right,
and put copper in the bucket with China. China, to me, is at that point where it's something some of us have been looking for decades, where it's tilting towards a severe reset of this parabolic growth. So you can't
yeah,
get bullish copper without that. Silver obviously has the PV, the photovoltaic demand, but solar demand, but it's not
yeah.
even 15% of total. So gold first, more likely silver. I don't know, but I'm worried that here's my bottom line. Copper right around $3.80 a pound. I think is more likely to go to 3,
Hmm.
which means it should pressure silver closer to 20.
Yeah, absolutely. Well, we'll see what happens in the market and how it develops in the next year or so with silver and gold. I'm sure that silver will hopefully follow gold. If gold does take off, I hope that everyone in our community is hoping that silver will follow suit. But we'll see. It all depends on what happens in the market. Now, what else is concerning you right now on your mind in the markets, Mike?
Well, let's look at it. Let's talk macro and micro. So first, I'll talk micro. The best leading indicator, most significant leading indicator, I think, is Bitcoin,
Hmm.
and it's been really underperforming since Q1 in the 2H. It's down like 12%. Nasdaq's up about 10%. And showing me what I think was supposed to happen if I'm right about just taking wealth away from everybody, what typically happens in the bear market. So there's a good
Hmm.
leading indicator. Again, recently this week, there's so much bullishness in this space. And me
Yeah.
as a strategist and an ex-trader or an ex-money manager, I look at that, I'm like, yeah, be careful with that one. So it's showing divergent weakness. I think it's indicating my tilt towards eventually the stock market's going to just drop like it does for normal correction. So that's the micro mini indicator. We'll see where it works out. Everybody knows we're going to get ETFs. Okay, it's very saturated. The macro is I'm going to be publishing on what I think is happening with China, this unlimited friendship between President Xi and Mr. Putin, and the war in
Hmm.
Ukraine is a paradigm shift. I think that's tilting most of the China's major customers um, away from importing from China, and that's Europe and in the U.S. The U.S. now imports more from Mexico than we do from China. It's rapidly moving. Then you just quote from President Biden, the ticking time bomb. There is a complete consensus in this country to GMTFO with China. Get me the heck out in every way, shape, or possible. So that to me is bad for all industrial metals, bad for maybe even might pressure gold a little if they have to liquidate. But this is
Hmm.
a paradigm shift that's way overdue that puts China, I think, in a similar position as peak Japan and peak Soviet Union about 30 years ago. So that to me is the macro, and there's micro indicators. And then we have this 100% probability of recession in the US in the next
Hmm.
12 months from Bloomberg Economics. Yes, they've been early, but everything I say points closer to that. And the bottom line is we still have the US Federal Reserve still tightening. Then okay, we'll finish with this. Still tightening. We've got the U.S. 2-year note got up to around 5% recently, just above that. I
Yeah.
think that's a pretty good peak. The 2-year note yield in China is 2% or so, and still going lower. They're still stimulated. That wide spread is the widest since 2006. So it's
Wow.
strong for the dollar, which is not good for commodities, and it's just
Yeah,
a
yeah.
train wreck, I think, happening in China. So to me, this is the next key thing that's going to be playing out in the next 6 to 12 months is what happens with China, and it might be like, I mean, remember when the Nikkei peaked in 1989? It's still not exceeded that level.
Yeah, absolutely. You nailed it there, Mike. It's such a pleasure having you come down and talk about commodities because yeah, as the US dollar does get stronger or yeah, it does hurt commodities. That's a for sure thing. Now, just to close off everything, where can everyone find you, Mike? Where can they get to you? I'll put your social media links in the bottom of the description, but where can everyone find you?
Well, thanks for I'm at the Bloomberg terminal first. At LinkedIn, just Mike McGlone
Nice.
Bloomberg, and at my Mike McGlone 11 on Twitter. And I'm happy to add people on my distribution list. Just
Nice.
shoot me a message and with an email.
Awesome. Well, thank you so much, Mike, for coming down to Wall Street Silver. It's been a huge pleasure. And yeah, we'd love to have you back on in the next 2, 3 months just to see what happens with Powell, the markets, everything, treasuries and all. So yeah, thank you so much, Mike.
Thanks for having me.
All right, take care.